From the Motley Fool is here with me in studio. Tony Farnham from Patterson Securities, as well as Chris Conway from the Australian Stock Report. He's joining us live from Melbourne. Chris, I will indulge us all for just a moment. Congratulate you on winning Australian Stockpicker of the Year at the Australian Stockbrokers Foundation Awards on Thursday. Congrats.
Thank you very much, Nadine. Much appreciated.
All right, let's talk this market today, Chris. Should we be concerned that we've seen this pullback, or is it perhaps to be expected considering the extent of the gains that we saw through the 5 trading days last week?
I certainly think, Nadine, it's somewhat to be expected. Look, we never like to see losses, of course, but we did, as a collective market, expend a lot of energy breaking above 61.50 over the past couple of weeks and then running very hard and very quickly up to 62.50. So clearly that sort of trend and that sort of pace is not sustainable. So we've taken the story this morning out of the Wall Street Journal of Trump threatening further tariffs and sort of run with that in the Asian session and obviously leading into the European session as well with futures down there. But ultimately I don't think it's anything we need to be too concerned about. But then again, we wouldn't want to retrace all the way back to 61.50 because we'd be right back where we started.
Yeah, well, let's hope we don't get there. Tony, your perspective on the day that was?
Yeah, well, a bit of support for utilities. The materials guys were always going to get a kicker after the events last week. And of course, the energy guys, I'm surprised they didn't get a little bit more again, given the wash up from OPEC Plus, as the production accord is now stated. Financials off. Again, I can understand the selling a bit in CBA, but for me, hey, 500 million off, and they made the decision to not keep the vertical integration process. For me, I preferred if they did. I think Westpac's on a winner longer term, but they've got company and the other two banks doing the same thing.
Yeah, Scott, I'm curious. First of all, walk us through exactly what CBA did announce today, and then perhaps why you think the market reacted as it did. Because we've known that this is coming,
right? And
you know, it looks like it's going to work in shareholders' favour, at least in the short term, the way that this demerger, the spin-off, is being structured.
Yeah, that's right. Look, the company decided today, or announced today finally what it had been planning to do, what we all expected would happen, which is demerging its wealth management business, and it's looking at demerging or selling off its insurance businesses, basically becoming back to a business and retail bank. And that's kind of the foundations of all of our banks here. They've spent the last 20 years building ancillary businesses in the quest for growth, in the quest for other business lines to diversify their businesses. And yet they've decided, largely as a result of the Royal Commission, some will say because they weren't winning. We know that ANZ boss Shane Elliott used that term previously. That's originally why they were talking about it. Of course, the Royal Commission puts that in a different light. And they're also looking at the fact that maybe there's money they can use, equity capital they can use to shore up those balance sheets. It's kind of a nice win-win. If you're going to have to do it anyway, do it as a result of the Royal Commission, show you're doing the right thing, bolster those balance sheets. It's a good result. I think to your question, though, that the answer is to the extent these companies bought them, and we saw ANZ today say they bought their wealth management business specifically to cross-sell. When you take that away, it's hard to believe that the two separately aren't worth less than together for that exact reason. They were using that vertical integration to take out costs and to drive volumes higher.
Is that how you see it, Chris Conway, at the Australian Stock Report?
Yeah, it certainly is. I agree with Scott's comments. I might just add in there might be some concern about the price that they can get, of course. You know, what it will list at and what it will mean for shareholders, hence why the sell-off today. So there's the uncertainty around that. And yeah, taking away that ability to cross-sell products, I think is hugely important.
And do you think that we're seeing, you know, a continuation of, you know, is this that shrinking to greatness kind of thing, and can it be executed by Matt Comyn? Because you can't also overlook the fact that, you know, he's made some significant changes in the C-suite as well.
Yeah, I think the bigger read-through here with Matt Comyn is he's come in and he's taken a sickle to not only doing the deals to settle all the AUSTRAC issues and some of the other compliance issues that the bank has been through, but he's also putting his stamp on what he wants the bank to look like moving forward. So he certainly stamped his authority on it. Whether or not it's the right decision, the proof will be in the pudding. And I'm sorry, I don't know who the other commentator is on the panel, but obviously Westpac now is the only bank that has an aligned wealth management division. So we will be able to see very clearly in coming years what the scorecard reveals.
they've kept their salaried financial planners, so there is still some financial advice there. It's just they're not creating those products from what I can see. And of course, they're going to keep ComSec. So they're still about finding that self-managed super fund market and other markets like that. It's just they don't want to be imperiled by the dramas that we've seen in the Royal Commission of creating a product, then having created the product, demanding that the people within the organisation sell that product and almost that product alone.
Yeah, all right.
Keeping those planners, is partly, I mean, the great thing for consumers, to the extent they remove vertical integration, and you can go to your bank branch, you get unbiased advice, pay by the hour, whatever you're going to do to get that advice. That's great for most consumers. It's the vertical integration where they were selling their own company's products that caused the problem. And to Chris's point, that's why the concern might be that trying to get good value for these businesses that are previously profitable in part because of that cross-selling, you take that away and you would think, well, they should be worth less. And to that point, they're doing it now because they kind of have to. And maybe it is good for some equity, but the price will matter a lot.
Yeah, all right. Look, we could talk about this for much longer, but let's move on to another big story out there in the market today, and that is Metcash. So Metcash disappointing on many fronts, one could say. Not so, though, when it comes to returning capital to shareholders. We've seen the share price close up likely by about 1.6%. So what is this strategy? What's going on here at Metcash, Chris Conway?
Look, obviously they're trying to, make sure that their food and liquor sales stay robust enough so that they can support the rest of their business, which is actually, to be fair, performing pretty well. And I mean by that the homewares division. And yeah, maybe softening up shareholders with the buyback. You know, the bigger story here for me, and forgive me if I oversimplify this, is the competition in this space. We still know that there's a price war going on between Coles and Woolworths, of course, not to mention Aldi, and now Kaufland is on the way as well. They actually have a site down here in Melbourne that they're building on in Dandenong, which is not too far from where I hail, and they're going to shake up the industry even more. So just as I look across this competitive landscape, you know, as I said, it's increasingly competitive, and I struggle to see where Metcash fits in with its food and liquor offerings. You know, everyone has said all along that it's been a position of convenience for their stores, but now you've got stores like Woolworths Metro that are coming in and taking their share as well. So I think this is increasingly difficult for Metcash. So yeah, sure, the buyback today, 125 million, it's nice. Share price gets a bit of a pop, but I just worry about the long-term longevity of this company.
Is that oversimplifying it for Metcash, or is that just the bottom line for Metcash?
I wish it was for Metcash's sake. I think Chris is dead on. I think when you are in such a structural challenge for food in particular, I agree with Chris. The liquor business is really good. The hardware business is pretty good in my mind. The real concern is that the company's got nothing better to do with that money than give it back. It's almost white flag stuff. Yeah. It's almost saying, look, we got nowhere to go here. The business is in structural challenge. We're going to have to do our best. You might as well have the cash back. Look, we like buybacks most of the time. Most shareholders like getting money back, and you're sure the shares pop today. But it really is a sense of it's putting more strain on the balance sheet. It's not fixing any of the fundamental issues. And no one, I don't think, believes the food business has a viable growth future. At best, it'll shrink more slowly than people fear. If that's the Metcash story, and that is still the dominant share of volume of sales and profit, there's not a lot of blue sky, I don't think, for Metcash. So yes, they've taken some money off the table, and maybe they've avoided wasting money on something else, so maybe that's a positive for shareholders. But if that's the best you can say about it, it's a company under some structural stress right now.
No blue skies there. Stormy clouds continue for the whole of that food business. Okay, hardware and liquor, tick. Give that, but all they're doing is giving a sugar hit for investors that are going to leave the company and or at least lighten their holdings in the company, but then they'll wake up the following morning, the rest of the shareholders, and they'll find the same challenges are still there.
Yeah, sugar hit on a day that the Australian Beverages Association has agreed to reduce sugar content in their drinks by 20%, I believe it is, by 2025. I digress. We could go into Coca-Cola Amatil at this point, but I'd like to just, while we've still got Chris, get a few of his current picks, this being the Australian Stockpicker of the Year, of course. You've got your eye on bingo, and you're not the first person who sort of said this on the channel, Chris. How do you sort of view this area of the market developing here in Australia in the sort of months and years to come?
I think it will be a story of consolidation, Nadine, and that's one of the reasons why we like bingo. Currently, the waste management sector is very fragmented. There's a lot of private companies, and with the increased regulation that is being forced upon these businesses, Obviously there'll be cost pressures and margin pressures. And Bingo as a roll-up, typically I don't like roll-up stories, but these guys are cashed up. They have the ability to absorb those regulatory costs, and they will survive when a lot of other smaller players in the industry won't. And of course then they can be consolidated into Bingo, and they are on the acquisition trail. So yeah, look, that's the reason why we like it. We think they have a pretty strong growth platform.
It's an interesting one because you've also got to think, given the pressures coming in the waste management space, that China has essentially shut itself to others' waste. When it comes to innovation, I mean, is Bingo Industries innovative? Because you've got to think that there's plenty of opportunity for somebody in that space to come up with waste to energy or other sort of more blue sky type prospects and scenarios.
I don't know whether they have the technology innovation currently. It's more about just developing market share. They have built a new plant, and I think ultimately long term, if they can parlay the experience that they're going now and the scale that they're going to be achieving into, as you say, creating energy or keeping that material here onshore in Australia rather than shipping it off to China and finding a way to turn a profit from that, then they'll be in a good position. But yeah, I don't think the business is quite at that point just yet.
Okay, what else is on your watch list? What are you liking these days, Chris?
Aristocrat Leisure is another one. I know it is trading at or near all-time highs, but this is a phenomenal growth story, and it's really in that digital space. It's just an exceptional company that has managed to absorb some pretty big acquisitions, the likes of Plarium and Big Fish, and as I said, grow in that digital space. I think they had user growth last time out of around 600%, and I know a lot of that stemmed from the acquisition of those two companies that I just talked about, but it seems to be a growing space within that industry, and they're extremely well placed. And as I said, they have done it before with these sorts of acquisitions, management that is, and you trust them to do it again and again and continue to grow.
You've got to say that BHP today, I'm just trying to check, would be one of the best performers by index weight on the 200. How do you view the resources complex at this stage of the cycle, Chris?
I'm still very much a bull, particularly in the oil space. I've said, been on record multiple times saying I think at some point this year oil prints somewhere in the 80s. And I've had viewed until, of course, last night when it jumped 5%, the recent pullback in the oil price is another opportunity to get long. So, yeah, I like BHP for its diversification. Newcrest is another one that we've been looking at just because they've had some transitory problems at their Cadia mine, which, they should be able to overcome relatively easily. But, yeah, on the whole, I'm still bullish on commodities and would be happy to play in that space.
All right. Chris Conway, Australian Stock Report. Thank you so much for your time today.
Thanks, guys.
We'll speak soon. Now, we